In the previous chapters, we examined the market's dependence on sustained AI capital expenditure, the late cycle stretch emerging across selected semiconductor names, and whether monetization is beginning to catch up with the scale of the investment. This chapter asks a different question. What can sit on the other side of that trade? This material is for informational purposes only. It does not constitute investment advice, an offer, or a solicitation. The objective is not to abandon technology or predict an imminent reversal in the AI cycle. It is to identify businesses whose relative performance behaves differently. Companies that may provide diversification when the dominant AI tech trade weakens, but which remain investable on their own merits. The hedge must be sourced from fundamentals, not from fear. We build the argument through three separate lenses. A top-down analysis identifies the first visible area of pressure. A bottom-up study maps the sectors most negatively correlated to the AI leaders. Our own model then converts that framework into a disciplined stock selection process. The first symptom appears in software. Relative to semiconductors, the group has fallen to levels last seen around the peak of the dot-com era and is now deeply oversold, but the comparison is not perfectly clean. Microsoft and Oracle represent a large part of the software index and are themselves heavily exposed to AI infrastructure. So, the signal deserves attention, but not a simplistic conclusion. Rather than treating all software companies alike, we ask which franchises can survive the derating on their own economics. Growth must exceed what the share price already implies. Free cash flow must be real, and valuation must leave room for disappointment. This is deliberately a fundamental screen rather than a momentum screen because the group's recent performance has been weak by construction. 14 companies pass. The common feature is maturity. Established franchises, recurring revenues, and genuine cash generation, trading at valuations that do not require heroic assumptions. By contrast, the highest multiple names are excluded precisely because much of their future success is already reflected in the price. The more important signal is the sequence. Software multiples are falling, while near-term earnings estimates remain relatively resilient. That often means the market is discounting a change that analysts have not yet incorporated into their long-term forecasts. The multiple moves first. The estimates may follow later. History offers a useful rhyme. Newspapers and directories once appeared protected by sticky customers, strong cash flow, and high switching costs. Their valuations began falling before the earnings collapsed because the market recognized the structural threat before consensus did. Software is not the same industry, and incumbents can deploy AI themselves. But the shape of the risk is similar enough to monitor. The companies most negatively correlated to the AI leaders share a surprisingly consistent profile. Their earnings are predictable, returns on capital are stable, leverage and market beta are generally lower. Growth is slower, but less dependent on the continuation of the AI capex cycle. They have also become historically inexpensive relative to the market leaders. This leads us to four areas: communication services, consumer discretionary, consumer staples, and healthcare. These are not identical defensive sectors. The opportunity includes telecoms, retailers, house builders, autos, consumer franchises, pharmaceutical companies, and healthcare services. The common denominator is diversification from the prevailing AI exposure. Our first metric is the beta ratio. It compares how a stock participates in rising markets with how it behaves during declines. A lower ratio indicates a more asymmetric profile, meaningful upside participation, but comparatively better protection in drawdowns. That is more useful than simply buying the lowest beta stocks. The second metric is total yield. This combines forward free cash flow yield with the structural pace of share repurchases. It measures the cash a company can generate and return, rather than relying only on dividends. For a hedge sleeve, that matters. The position should be capable of funding itself while the broader thesis develops. The final screen combines valuation, cash generation, and momentum. Companies must rank within the strongest part of the model, offer a total yield above 5%, and already show positive risk-adjusted performance. Of the 75 names considered across the four sectors, 33 pass all three tests. Outside healthcare, the result is a diverse group of telecom operators, consumer businesses, house builders, autos, and selected defensive franchises. The list is not built around one macroeconomic forecast. It is built around cash generation, valuation support, and differentiated market behavior. Healthcare provides the deepest opportunity set. The qualifying names span managed care, pharmaceutical companies, diagnostics, and healthcare services. This breadth matters because it allows diversification within the hedge itself, rather than concentrating the entire thesis in a small number of defensive stocks. The conclusion is not a rotation call. Software remains a symptom to monitor, not automatic evidence that the AI cycle is ending. What the analysis provides is a potential hedge sourced on merit, negatively correlated businesses with cash generation, valuation support, and positive momentum. The objective is not to predict the precise moment when leadership changes. It is to ensure that a portfolio is not dependent on only one version of the future. This material is for informational purposes only. It does not constitute investment advice, an offer, or a solicitation. For the PDF version of the paper, we invite you to contact us.